Hey, Adam Hooksema here from ProjectionHub, and in this video, I'm going to do a deep dive on add backs as it relates to SBA acquisition loans. So I'm going to show you some example anonymized data here from a client that was looking to buy this particular business and provided me with some financials, and they were kind of trying to figure out, what should I pay for this business? What's it worth? What could it qualify for in terms of an SBA loan? And this was an example where, at the end of kind of the analysis, the initial analysis of getting their financials into our model, I was kind of like, I don't know whether this deal is worth zero, if this business is worth nothing, or if it maybe has some substantial value. And all of that depends on add backs. And so if you're looking at buying a business and maybe you are looking at a deal where the seller's proposing a whole bunch of add backs, what I'm hoping to do in this video is one, kind of outline what types of add backs will an SBA lender let you get away with, like what are they going to allow you to include as an add back, and also where to hunt for add backs. So if you think, if you look at kind of first glance at a deal and you're like, this doesn't look like it makes any money, but the seller's claiming that, hey, it's a really valuable business, and you might be wondering, where's the disconnect? It could be in the add back. Before I dive any deeper into that, like what is an add back? So basically what we've got here, we're going to take the seller's financials and get them into a model here so we can kind of look at all of their revenue and expenses. And then there are what we would call add backs or adjustments from the kind of tax return net income. And those add backs would be things that maybe weren't discretionary expenses, things that you wouldn't have to actually spend on, or things where the seller is effectively paying themselves and there's an expense here, but it's actually somehow coming back to them, right? So that could be through wages, that could be through rent. Maybe they're paying themselves rent for a building that they own. And so we'll get into kind of looking through these line by line and hunting for add backs, I'm going to try to point out how would an SBA lender look at this? Would they consider this an okay add back or not? So just at first glance, I just want to show you kind of the way that we looked at this deal. I've just got the basic information into the model as it was presented to us. And then the proposed acquisition price was $650,000 with 10% equity injection. And then the rest was going to be an SBA loan. That was the idea or the hope. And so I put that into our model. And based on that, in a 10-year SBA loan, you'd have proposed annual debt service of $92,770. So just looking at our estimated cash flow here, what you can see here is this prior year's debt service coverage ratio based on that proposed loan. It's, in this case, 0.36, which means you have 36 cents of cash flow available for every dollar of debt payments that you're going to have. So that doesn't work, right? And actually then in this year you had negative $1.74 for every dollar of debt service. So you're really in the hole there. So as we, got the numbers in here, right off the bat, I was like, there's just no way this is going to qualify for anywhere close to a loan of this amount. In fact, it may not qualify for anything, probably just based on what we're seeing here. I think that there is some opportunity here that there could be a whole bunch of add backs. And I want to show you what I told the potential buyer to start digging into and see, maybe there is something here. So let me show you. So the first expense that kind of sticks out to me as a potential add back, this was a retail store and they have car and truck expenses. They probably don't, they shouldn't need a car or truck for operating this business. So this is probably a personal vehicle that maybe they're paying the payment through the business. Maybe that's a legitimate add back. The lender may not let the seller get away with that, but that may be a thing that you as a buyer would say, okay, well, I'm not going to have this expense. So actually, the business would be more profitable than it looks like, right? So you have potentially car and truck expense. So I'm going to come here. I'm just going to say, let's just look at this in the most charitable way possible. Let's add that car and truck expense, and we'll bring those add backs in over here. Okay, so let's assume we're adding that all back. Depreciation, we already had in the model. We're already adding back depreciation. You can do that. Every lender is going to let you add back depreciation most of the time. Now, there could be some businesses where you continually need capital expenditures. So like a trucking business is a good example where you're buying trucks. Every year you're upgrading your fleet. You're buying a new truck, replacing old trucks. You're going to have depreciation every year, but you're also going to have to probably spend on capital expenditures every year. So that's a situation where the lender is going to say, we're not going to let you add back all the depreciation, or they may kind of look at it and say, okay, yep, you can add back all your depreciation, but we're going to come in here and say, capital expenditure, and actually do like a negative number. So let's say you got to spend $50,000 a year on capital expenditures. So they may say, yeah, you're going to need to spend an additional $50,000 just to upgrade and keep your fleet up to date in that trucking example. So that could be a situation where you have the depreciation add back, but you're kind of have a counter add back on the capital expense side. All right, that's not really relevant for this particular deal because it's not a trucking business. They don't have capital expenditures, so they should be able to add back the depreciation. The next place I would look to hunt for possible add backs is insurance. A lot of times sellers will put their whole family's health insurance, their family's vehicle insurance or home insurance is like sitting in here in this insurance line and probably really shouldn't be. Again, this is going to be a question of, will the lender allow you to add that back? How much? You got to document it. They may or may not let you do that from a lender perspective. But from you as a buyer perspective, maybe you say, yeah, the business insurance here was only $25,000. So I should be able to add back, maybe 50% of this insurance line. I think I can add back. So maybe you come in here and we say, we're going to take that insurance number, multiply it by 0.5. So we're going to take half of that each year, and we're going to add that back. You're certainly going to have some business insurance, but maybe it's overstated. So that's a possible place to look. And the next place to look is rent. Rent is a big one here. It's a big expense for this particular client. A lot of times the business will own its own real estate. Not all the time, but sometimes it'll own its own real estate. So in this case, let's say they own the building and they have it in a separate entity, a real estate holding company, and the operating company for this retailer is paying rent to the real estate holding company. Well, they're just paying rent to themselves, right? So that's a legitimate add back. The lender would say you could add that rent expense back. So perhaps that's possible in this case. Now, you'd only be able to add that back if when you acquire the business, you're acquiring the real estate as well. If you're not acquiring the real estate, then you're going to have to pay rent to the seller who still owns the real estate, right? So you would still have this rent expense and you wouldn't be able to add it back. But in situations where you're acquiring the real estate, you can add back rent. So let's just assume, again, in the most charitable way here that we're adding this all back. Okay, another thing that really stuck out to me on this one, taxes and licenses, there's some pretty substantial tax and license expense, and it didn't really make a lot of sense to me. I was looking at sales. I mean, sales are actually down $1.5 million from 2022 to 2024, and yet this taxes and licenses was double. So I have no idea what's going on there. That feels like, maybe they had the business pay their personal income tax and counted that as an expense or something. I don't know. That feels like maybe ripe for some sort of adjustment or add back there. Definitely something to look into. I am not going to include anything here in our analysis because it doesn't make a lot of sense to me. It's probably not an add back, or if it is, there's some explaining to do. So let's exclude that one for now. It's not taxes would not be a common add back. Wages could be a common add back. And actually, this may actually solve our sales tax and tax. It's actually, there you go. It's in two different line items. So I think if you added these taxes and licenses and the sales tax row together, that actually makes a lot more sense. So that's probably what happened. Okay, let's look at wages. Wages here is a common potential add back because the seller might be paying themselves, might be paying a family member who, maybe does a job but isn't absolutely necessary in the business. So here's it's a pretty big number here. So it could be that they paid themselves a salary of $150,000 and they had their family member who they also paid $50,000. Maybe $200,000 of this could be added back, right? So let's do salaries or wages, I guess, here in this example. And let's just assume $200,000 is an add back because that's the seller's wages. Now, this is kind of like the depreciation, the capital expenditure conversation that we just had. With wages, if you're adding back the seller's wages, but you as the buyer, if you're going to need to take a salary out of the business, then the lender is going to make you, unadd back or, include a proposed salary, right, for yourself. And they're going to look at your personal financial situation and they're going to determine based on that how much of a salary they're going to make you take. And so if you've got, no debt, they may say, hey, you just need bare minimum living expenses. Maybe they make you take $50,000 out a year. If you've got, 6 kids all about to go to college in the next few years and you've got, a big mortgage and a boat and all this and a lot of costs to be able to just keep up with your bills, personal bills, they're going to make you take a substantial salary out of the business. They're going to require that. And so that's a big unknown here too. In this particular case, I don't know the buyer's personal financial situation. So I don't know what the lender's going to make them take. But let's just say buyer's salary, let's say it's $75,000. And actually here we want to do a negative $75,000 because the buyer's going to have to pay themselves that. Okay. All right. So any other major obvious add backs? We have sometimes travel. Travel is one that a lot of times seller will try to add back travel expenses. A lot of times, and lenders are probably not going to be too excited about doing that. They're just, the question is going to be, why are you on your taxes expensing a personal vacation on the business tax return? And they're probably just going to say, if that's what you were doing, like you're not going to get the best of both worlds. You're not going to be able to do that and kind of, cheat on your taxes, right? And then also get that added back from an SBA loan perspective. Remember, the SBA is a federal government agency. So yeah, they're probably not going to, lender's probably not going to report the seller to the IRS when they tell you that, but like, they're not going to be excited to hear that or give you credit for that add back. Okay, loan payments. So we also did an adjustment here for loan payments because the assumption here is that when you buy the business, all the previous debt is paid off. And so you would only have the debt of the new SBA loan. So if we look at this, I think that's the main add backs here in this scenario. And if we look at this now, we had a lot of add backs, but we get to a point where, hey, there actually is some seller's discretionary earnings here and some estimated cash flow. And we can say, okay, now based on that and this proposed SBA loan for the acquisition, there is, a debt service coverage ratio of 3.08 in 25. It was short in 2024, but it did meet in 22 and 23. It was over the 1.25, which is typically the minimum. So some lenders may say, hey, if any time in the last few years you were less than the 1.25, some lenders may not want to do the deal. And so what that would mean in this case is you probably just have to keep lowering that dollar amount of the loan, bring the dollar amount of the loan even lower. You got to put in more equity. You got to lower the sales price, something like that to get that to 1.25. But some other lenders will say, hey, if you can explain what happened in 24 and how that's been corrected and going forward in 25, we're back in business and the debt service coverage ratio looks strong. Okay, you might be able to talk through that. So I hope that's been helpful. That's how an example of how you could take a business that when you first look at the tax returns, you think, oh, this is ugly. There's not a single year here where there's any net income. There's no way this business is worth anything. It doesn't look good when you first look at that. But maybe these add backs, some of these might be legitimate, able to document them. And some of them the lender may accept or may not. If you talk to 10 different SBA lenders, they're probably going to come up with 10 different numbers for estimated cash flow because they're all going to have different opinions. It's an art, not a specific science. And it's how well can you do documenting and justifying those add backs to see what you might ultimately qualify for. So I hope that's been helpful. If it has been, let me know. I'm thinking about doing more kind of deep dive videos like this on particular deals to show you real life examples. So like the video, leave me a comment to let me know if you'd like more content like this, and make sure to subscribe to our channel so that you can get notified when we have new content for SBA deals. So we love your feedback. If you have a deal that you're working on and want our opinion on it, to take a look at it, feel free to reach out to us at support@ProjectionHub.com for a free SBA review as well. So happy to take a look at your deal and give some free feedback. We'll put a link to the free SBA review form in the description of the video below so you can take advantage of that. But yeah, hope this has been helpful. Thanks.